Am I audible? Hello? Hello? Am I audible? Hello? 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 Am I audible? Hello? 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 Am I audible? Is it my voice clear? Hello? 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 Am I audible? Is it my voice clear? Hello?
नमस्कार our country
Hello? Hello? Am I audible? Hello? 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 Yes. Good morning to all. Today is day 7. Today we are going to discuss the very important topic. It is called as marginal costing and decision making. Right? So before going to start, we are in the block number 4 units. Block number 4 is one of the units, marginal costing and decision making. Let's discuss one by one. Now, what is marginal costing? How it will work? Okay. Wait a minute. I will share the screen. Right. So today's our topic is we are going to discuss marginal costing and what is the meaning of marginal costing? What are the characteristics of marginal costing? And CVP analysis, cost value profit analysis. What is the decision making for short term as well as long term? Under we are going to discuss also as a break-even analysis, margin of safety, angle of incidence, and the contribution ratio. So first, what is the meaning of marginal costing? So marginal costing is an economic is incremental cost of production. So whatever the changes happening in the production, right? Whatever the change happening in the production, like we'll take as a 10 units to if we move to 12 units, the units of production increased by 2 units, 10 to 12. But what about the cost? So cost is incremental increase or any changes are made due to what we are getting any advantages from these fixed cost, right? So like these marginal costing are explaining variable cost and what is the relationship between this fixed cost. Fixed cost, no, naturally the fixed cost remain constant irrespective of its production. Okay, and see here one of the example is given here. 10,000 units. The total cost is 3,50,000 rupees. Whereas if you production increase 10,000 units to 10,001 units, means we are going to produce additional 1 unit. The cost is additional cost increase is only 20 rupees, right? If you see here in this table, the direct cost per unit is increased for 10 rupees and direct labor is also increased and other overheads also variable overheads increased is at 10 rupees. No increase in the production, no increase in the fixed cost. So fixed costs remain remain constants. Okay. So here you can see here the 20 rupees additional cost, the company produced 1 additional units. The company produced 1 additional unit for just the spending of this 20 rupees for 1 unit. So now before going to can understand what is the direct cost, what is the indirect cost, right? So direct costs are associated with production. So if the production increase, the direct cost also increase. So direct cost means the cost is directly participated to produce the products. Okay. So you can see the product here, direct material, direct labor, and direct overheads, mission cost. If it is a batch level, depreciation on machinery, depending upon the production level, how much the production level using, you are using 50% or 60% or 70% or 80%. So what is the level of production and how these indirect costs are allotted to different apartments, right? Different departments. So what are the characteristics of this marginal costing? The marginal costing is a very good technique and also is very close distinct with production cost and the period cost and the only variable cost. So when you talk about the marginal cost, we'll consider the variable cost, right? So here, what are the characteristics, major characteristics? One is all elements of cost are classified into 2 components fixed cost and variable cost. And sometimes what we call is semi-variable and also semi-fixed cost. So very simple, as per marginal costing, the total cost are classified are divided into 2 variable cost and fixed cost. The second one is, second characteristic, the marginal cost are nothing but the variable cost includes direct material, direct labor, direct other overheads. okay, are treated as a cost of production. So we know this balance cost sheet, right? So whatever the cost included in the cost of production, we call as a marginal cost. So marginal cost include all direct expenses. So marginal costing is also the value of finished goods and included work in progress is also compared only in marginal cost. So we know that there are different stages of this production, raw material, work in progress, finished goods, stores and space like. Right? Variable spelling and distribution expenses also are excluded for valuing these inventories. So fixed costs are not considered for valuing the closing stock of finished goods and work in progress. So fixed costs are treated as a period cost and are changed to profit and loss account for the period which they are incurred. Okay, and the prices are determined with the reference of marginal cost and contribution margin. So wherever the company, production company, they want to fix the selling prices, and they are considered these marginal costs. But based on that, they can change the price rate, either increase price rate or decrease price rate or fixing the price rates. So every firm is a major objective. Profitability of department and products is determined whether with reference to contribution margin. So when you're fixing the price rate, the very important component is the marginal cost. So what about the facts of? So what are these limitations? What we call right? It's not a distinction. Sometimes it's not possible to segregate or classify all expenses into variable and fixed. Sometimes it's a semi-variable or sometimes it's semi-fixed cost. So depending upon the nature, right? So it is very difficult. And the cost assignment, we can ascertain cost from the cost department of cost department. So decision-making process we'll discuss in later part. Decision-making process, how will decision-making will understand. So departmentation of fixed cost. So how we can allot the department, A department, B department, C department, right? So the very important component here is, contribution is equal to sales minus total variable cost. Right? So we know what is the meaning of the contribution. So contribution or contribution margin is the difference between the total sales minus total variable cost. So we will show in the form of this formula C is equal to S minus V. So here the contribution means it includes both fixed cost as well as this profit margin. Okay, it is obtained from subtract the sales and variable. It can also be defined as excess of sales revenue over the variable cost. So after meeting the variable cost, whatever the excess amount is there is called as contribution. It also includes both profit and fixed cost, right? So contribution includes both fixed cost plus profits, fixed cost plus profits. Okay, so it's also called as a joint cost, which include equitable proportion to all this, right? So let us we'll go for one problem practice. Right. So variable cost, fixed cost plus sales. So contribution is equal to sales and variable cost. Sales is 80,000 and variable cost 50,000. 30,000 is called contribution. Right. So now we need to calculate the profit. What we can do is contribution minus fixed cost is also calculated profit. So in simple formula, what we can do is S minus V is equal to C contribution. Contribution is equal to F plus P. F plus P. Right? So what we can do is, this is the formula we can apply here. And sometimes you want to calculate fixed cost is equal to, what we can do is contribution minus profit is equal to fixed cost. So you want to calculate the profit, what we can do is profit is equal to contribution minus fixed cost. So this formula we can apply in this problem here. So here we compare here. Contribution minus fixed cost is equal to profits. So like this is the marginal equation, marginal cost equation to calculating the variable cost or fixed cost, okay, or profits. This way we can calculating the fixed cost. Okay, it is also called as a period cost. So these are the costs which are not assigned to the products but are also charged as a expense against the revenues and all these. So difference between the marginal cost and absorption cost. So here you can see that when you consider this marginal cost, we consider all direct labor, direct material, overhead, where fixed loaded, factory fixed overheads, change to cost of production, all this. So this is cycle of this marginal cost. So let us discuss the comparison between, distinguish between marginal costing, absorption costing. It's also part in our syllabus. So marginal costing considered only variable cost are considered for product costing and inventory valuation. But in absorption costing, they considered both fixed cost as well as variable cost for considering the product costing and inventory valuation. Here it's considered only in marginal cost, they considered the only variable. They considered both variable and fixed cost for deciding the production cost as well as inventory valuation. Okay, this is the one difference between absorption costing and marginal costing. The second one is the fixed costs are regarded as period cost. The profitability of different products is judged by the PV ratio. So we can see profit value ratio we can use here, but here the fixed costs are charged on the cost of production. Each product bear reasonable share of fixed costs and these profit are. So here the apportionment of cost is there. So here they can use these PV ratio for knowing this company profitabilities. Okay. And the third difference. The third difference is the cost data presented in highlight in the total contribution to each product. So contribution is playing an important role for knowing the cost. But whereas the cost data presented in conventional pattern, net profit of each product is determined after deduction of fixed cost. After subtraction of fixed cost only, we know this conventional method we are showing the data. But whereas the marginal costing, the difference between magnitude of opening stock and closing stock does not affect any unit of cost of production. Okay, but here it will reflect it. The production opening cost and closing cost affect the cost of production due to impact of related fixed cost. Okay, here they are not considered as a fixed cost. There is no issue here. So here in case of marginal costing, the cost per unit remain constant irrespective of cost of production as it is evaluated at variable cost. So here the marginal costing, the cost per unit is remain constant. Okay, remain constant. But here we can see here in case of absorption costing, cost of production may reduce as the production increase. Means there is a close relationship between the production cost and as well as why because they included both fixed cost and variable cost. Here the only variable cost included if the production increases, the cost is also increased, total cost increase, but the per unit cost is same. Okay, difference between profit and so this is not our symbol, and this is the income statement of absorption costing. So let's move to our another topic. So go for some examination. So this is the margin costing and decision making in cost accounting. So earlier also I told you this contribution is equal to per unit contribution. We will calculate using this formula: sales per units minus variable cost per units. And see that the total profit or contribution minus fixed cost will calculate the total profit. Contribution is very simple: fixed cost plus profit, or sales minus variable cost is called as a contribution. So let us see that PV ratio. What is mean by PV ratio? PV ratio is a profit volume ratio. So it is calculated by using this formula: fixed cost. Okay, using this formula we calculated using the formula contribution by sales into 100. It means we sell this rupees 100 the product. Now what is the sales margin? Okay, how much the sales margin is there? Okay, what is the break-even point? The break-even point is a point where the total costs are equivalent to total sales. Okay, so break-even margin is no profit, no loss. So break-even point where the total sales are equivalent to total cost is known as break-even points. Okay, so break-even point in units, we'll use the formula total fixed cost by contribution. What here? Fixed cost by contribution will get the units of break-even points. So if you want the break-even point at sales value, it is called in time to rupees. We'll use the formula break-even point units into selling price per unit. So we'll get the sales value. Sales. No, we'll get this break-even point sales and break-even point at earnings on a specific net profit margin contribution by total contribution by contribution margin. So using these various formulas, we'll calculating this margin. See that what are the applications of marginal costing? Right? In our syllabus, there are various applications are given for using this marginal costing in decision making. So marginal decision related to determine the optimum selling price. So how these marginal costing are very useful for fixing the selling price of a products, right? So how to fix a like there are so many factors are affecting to fix a selling price, right? The one of the major factor is this marginal costing. Marginal cost one of the base. So determining the optimum selling price by any product or service is a big challenge of a manager or a firm. So in marginal costing techniques, fixed cost will not be changed at a all level of production. Fixed cost remain constant. Like we'll see this graph. Either you can produce single products or you can produce 100 products. These fixed costs remain constant. Fixed costs remain constant. Okay. So here what we can do is we'll take the production levels. So here we'll take selling price, variable cost, and fixed cost, right? So as per this marginal costing, the fixed cost remain constant. So let us see one example. Suppose a company wants to earn the 15% net profit margin on its 20,000 units sold. So what will be the selling price to fix? How the company going to fix the selling price? So the target is they want to earn at least 15% of net profit. And so here the price will fix. The following formula is given for additional information. In the form of additional information is given. Information given. Suppose fixed cost, which is fixed for either you can produce single product to 27 products, 1,80,000. The variable cost per unit is rupees 25. The decision can be easily taken using the marginal costing formula. So here, see the break-even units, the fixed cost plus profits, selling price minus variable cost, right? So here, what is the units are? 20,000 units in the fixed cost 15%, and the selling price is 25 rupees. So like that, so expected selling price 40 rupees. If it is a selling price 40 rupees, the company easily earn this. The net profit is 15%. The second is reducing this, reducing the current price on profit. So like we can use this marginal costing concept for various purposes. So we'll go for one by one. Wait a minute. Right. So first one is fixed selling price we discuss. So now we discuss this fixing the selling price. Fixing of selling price. And fixed selling price of the product are no doubt one of the most significant factors for modern management, how to fix a selling price. So this is now the market is, most of the markets are profit markets. So like various factors are affecting for fixing the price, right? But one of these major factor is marginal costing. So let us example, another example we'll consider for this, right? So let us X Limited is in a company. So an average of PV ratio, profit value ratio 50%. So these 50% include fixed cost plus profits. The marginal cost of production is estimated rupees 30. What will be the amount of selling price? So suppose if the selling price is 100, the variable cost is 50, the remaining 50 rupees is contribution. So here the PV ratio is C minus S, contribution by sales, it is 50%, right? So let us selling price, which the margin is rupees 60. So it is 100 rupees by 50 into 30 will get 60 rupees. So here we'll fix the price at 60 rupees level. The company may get this profit margin is 50 rupees. Like these concepts are very useful for fixing the selling price. Okay. We can also use another formula, selling price. See that here the PV ratio is equal to S minus V by S. S minus V by S will get this formula. What is S minus V by S? Here S minus V by S means selling price minus variable cost divided by selling price will get this PV ratio, right? So variable cost by sales 50 by 100, 50% is there, right? So selling price will be calculated using this. So here another problem is there. The company directors of X Limited has been approached with an inquiry for a special job. Since the company has working will below the normal capacity for recession period. So for this purpose, the cost department of the company estimated the following to the job. So these are the information available. The direct material is rupees 20, direct wages 500 at 500 hours at rupees 4 per hour. So 500 into 4 will get this direct wages in terms of rupees. And variable overheads, the normal rates, fixed is 2 per unit, the variable is 1 per unit. So you are requested to by the directors of the company to advise them about the minimum price of the may change, assume that the no production difficulty will be incurred. So here, so now we are in absorption costing using the technique. The total cost is 23,500. Here only 500 rupees. We are not included here fixed cost. So if you have included fixed cost, it is again 1,000 rupees added, right? From the above, it becomes very clear. The minimum is 22,500. That it is marginal costing, but by quoting so the company may also sacrifice the recovery fixed cost and profits. But as a fixed costs are increased, even the company does not have any accept offer or any price over the above may accept. So here more than 22,500 any is there, the company may accept the order or any quotes. Okay. So let us one more example. In a factory produce 100 articles for home consumption of the following cost. So like is one of the manufacturing company. So these cost sheet like this, the costs are direct material 40,000, the wages are 36,000, then factory overheads, fixed is 12,000, the variable is 20,000. The total overheads are 32,000, right? Administrative overhead is a fixed component, is 80,000. Selling and distribution overheads, and then the two again, the fixed is 10,000, variable is 16,000. Here the variable is fixed is 22,000 rupees. Fixed is there. So now the homemaker can consume only 1,000 articles at a selling price of rupees 150 per article. It can consume more article. The foreign maker for this product can, however, they consume additional 4,000 articles if the price rate may reduce 125. See the how to selling fixed rate. So now in domestic, the company selling the product is 155 rupees per article. But the foreign markets, and we receive an order, so they're asking to sell 4,000 articles at rupees 125. So what the company can do? Can a company accept this order or reject the order? Right? For example, in India, we are selling the product is 155. The company is selling the product is 155. But same time, the company receives an order from abroad, and they're asking to sell a product is 125 rupees, and the order is 4,000 articles. So we are able to sell the products at 125 rupees or not? So let us show this contribution of 4,000 units. So for unit cost is, the total is 40,000 rupees divided by number of units, 1,000 units, it is 40 rupees. And the 40 into 4,000 units, it is 1,60,000 rupees. The wages, 36,000 divided by 1,000 units, it is 36 rupees. and the total cost is 76 rupees. Here into 4, 36,000 into 4, nothing but 4,000 units. So 3 lakh 4,000. And this is per unit cost 76,000. The variable cost, variable overheads, the factory is 20,000 divided by 1,000, and selling and distribution 16,000 divided by 1,000. The per unit cost, the total cost is 112 is marginal cost. And here the 4 lakh 48,000, and the sales is 1 lakh, selling price is 125. So it is 5 lakhs rupees. 125 into 4,000. 125 into 4,000 here, 125 into 4,000. Okay, 4,000. So we have 5 lakhs rupees. Then again, the contribution margin is 50,000 rupees a contribution margin. Okay, so what it means, we can accept the foreign order and we can sell the product at 125 rupees level. So how we decided, we get the advantage of fixed cost. So the above statement is quite clear that if the foreign market order is accepted, why? Because still we are in contribution margin is 52,000 rupees. The company will get additional contribution of rupees 4,000 units at rupees 13 per unit, 52,000 rupees. At the same time, as its production operating above the BEP break-even point, additional contribution will be additional profit. As such, as foreign market is worthy trying. So we can accept the order. Why? Because we have an additional free capacity. The ideal production capacity is there, we can sell the product, right? So we can't sell the product the same price in 125 rupees in domestic, right? So the order from, we received order from foreign market, not the domestic market. The same product will sell in the India in 155, but abroad we can sell the product is 125. We'll get, even the price is reduced 30 rupees, but still we are a contribution margin is 52,000 rupees because of this fixed cost remain constant. The marginal cost advantage will receive like this. Okay, so this is one. The second application is diversification of products. Diversification of products. So in order to capture the diversification product, will produce a different kind of products. Either it is horizontal or vertical. So in order to capture a new market or utility of ideal capacity. So whatever the ideal capacity is there. See that earlier we produce, for example, we take an example for sugar company, sugar manufacturing. Earlier they can produce only sugar. Now they want to diversify their product. They can produce some alcohol, some other waste products. So like they can, earlier one more example, the company now they're producing only soap. The same soap company, they can also produce a different kind of product. They can go for detergent powders, or they can go for shampoos, right? They can go for any other related products like hand wash. Okay. So naturally, the question is arises before whether the profit for one product or not. So in this regard, it may mention that the new product is introduced is worthy or not, if you get the company is profitable or not, or they're getting any advantage of the fixed cost or not, that will go for this. See the selection of a more profit, how, right? So the company can also apply this technique in product diversification. It is worthy or not, it is profitable or not. Okay. The third application of marginal costing is selection of a most profitable product mix. So which product mix is giving the higher profitability, right? How we can fix this profitable of the products, right? So naturally, what we can do is which product giving the higher profit, that product will sell more. So if the which products are giving this lower margin, and we are not preferable to sell more quantity, right? So naturally, it is quite natural of any firm, they can give the higher price for most profitable products rather than the less profitable products. So let's understand this concept using this example. We'll go for an example. We'll go for one example. This is the following. One example is given. The directors of a company are considered sales budgets for next period. The following information are shown the clear to the management. The marginal product cost and contribution per units. There are two products. the total contribution resulting for each product. Product A, product B. The material is product A 10 rupees and B is 9 rupees. Direct wages 3 and 2 rupees. Selling price 20 and 15. The fixed cost is the total of 800 rupees. The variable expenses are related to production as per 100% of wages. Okay. 100% of wages. Variable expenses are related to products 100% of wages. So whatever the wages are there is 100%. 3 rupees and 2 rupees over 8%. The sales mix, there are different kind of sales mix here. There are 3 alternatives of the company. The one sales mix is 100 units of A products and 200 units of B products. So that is one option. The second option is 150 of A product, 150 of B products. The C is 200 of A product, 100 of B product. So which sales mix would be adopted and which one is give the higher profits? Which one? There are 3 alternatives are there. 3 options are there in the sales mix. The company can sell 100 of A, 200 of B, or 150, 150, or 200 or 100. Right. We'll see in a statement wise. So selling products, sales prices of A product is 20. The B product is 15. The cost, right? The cost will take direct labor 10 rupees and 9 rupees. Direct wages 3 rupees and 2 rupees. Variable expenses 3 rupees and 2 rupees. The total expenses are 16 rupees in A products, 13 rupees in B products, right? And the contribution margin is 4 rupees of B product and 2 rupees of A product. Sorry, B product is 2 rupees, A product is 4 rupees. So now the PV ratio contribution by fixed price is 20% of margin, profit margin here 13.2, 13 and half, 13 and half. So A product gives the higher profitability compared to B product. So which option is better? We have 3 options: A 100 units and B 200 units, or 150 units, or 200 and 100 units. So you can see the higher profit given this A product. So we'll sell more on A product than this B products. But the third option is better. Third option is better. The third option level, the company get the good profit margin. Why? Because third one is A is 200 units and B is 100 units. So for above comparative contribution statement, it is very clear that PV ratio B product is comparatively very high to B products. So what out of 3, which is the best option? The best option is sales mix of 200 units of A products, 100 units of B products. See here, A is profit is more 100. See here, A is 100. The total cost is 400, 150 units, and C 600, 200, so 800 rupees, and B is 200, 100, 150, 150, right? See the differences. I will show you. It is a compared statement. This is option A, this is option B, this is option C. Option C. So in option B, the total units are, there is no change of total units, 300, 300, 300, no change in the total units, but the only change in the cost. Okay, the cost is, you can see here, it is 800, it is 900, it is 1000. Okay, the total cost is 800 here. Okay, it is 600 here and 400 here. Okay, so like we'll take decisions using this marginal costing applications. So fourth one is make or buy decisions. So we'll make a product or buy a product. So which one is better? Okay, which one is better, to buy a product or wait a minute? I will show you one more make a buy a product. Wait a minute. Right. make or buy a decision. So it is determined whether to produce a product of a component or internally or to buy from the outsider supplier. So which one is better? So decision is based on the cost. So which cost is better? We can produce the product or buy a product. So which alternative is best? So cost of both or alternatives should be calculated alternative with less cost to be chosen. Okay, less cost to be chosen. And how to criteria for making? Criteria for making is to produce a product. The product can be made at a cheaper by the firm, right? The firm has able to produce a product at a cheaper or not. The finished product is being manufactured only by in limited firms. Okay. And third one is, the third criteria is the part needs extremely close quality control. I mean, the quality is also good. The part can be manufactured from the existing facility or experienced operators, right? Means existing or you can buy these experts. And to buy, what is the criteria for buying a product? So if high investment is required for making a products, so you have to establish a new plant and recruit new employees, and huge investment is required. So a lot of logistics are required to produce a product. Better to buy a product like buy a products does not have the facility for making, means some of the limitations are there. Skilled workers also required. Skilled workers are not limited. And demand is either temporary or seasonal. Means the demand of the product is continuous or it's seasonal base. The patents or legal formalities prevent for making this product. So let us, I will take one example. For example, a car manufacturing company. So the company, without tires, the company cannot produce a car. The tires are very most important. So the car manufacturing company, they have two alternatives. They can produce their own tires or they can buy the tires from other supplier. So which one is most best alternative for reducing the cost, right? This is the one option. So what are the approaches? There are three approaches for make and buy a decision. The simple cost analysis and economic analysis. The third one is break-even analysis. So let's go by one. So simple cost analysis. Okay. Simple cost analysis. Right. So in a simple code, it is concerned with the finding the actual expenditure incurred for a given product and the total value of economic resources used by the product are produced. Right. So for example, a company has buying a part of machinery for ₹1,000 each. It has extra capacity that can be used for produce the same. So the annual fixed cost of the unused capacity rupees 10 lakhs. If the company decides to make a product, it will incur the material cost is rupees 350 per unit. The labor cost is 300 and the variable overheads are 100. Means 350 plus 300, 650 plus 750 rupees. The future demand is estimated 5,000 units. And which decision the profitable of the company, right? Mean the company make a product or buy a product. Using simple formula, what we can do is, so what is the cost of this product? 350, 300 is 650 plus 100, 750 rupees. So means if you produce the products, the cost is 750, the only for variable. And the same products, company is buying in outside ₹1,000. Right? The company is spending ₹1,000 to buy a product in outside. So if the company produces 750, we'll see what is the decision. It is profitable or not to make a product. Right? So fixed cost is 10 lakhs and these are the expenses. The demand is 5,000 units. The buying price is ₹1,000. So let us, the solution is the total cost is equal to fixed cost plus variable cost. And the variable cost is 750 and in terms of rupees is 5,000 units into 750, 37 lakh 50,000 And the total cost, fixed cost plus variable cost, for 10,000 rupees for fixed cost and 10 lakh rupees the fixed cost, 37 lakh 50,000 variable cost. The total cost is 47 lakh 50,000. Okay. So the buying cost, if you buy a product and 5,000 units into 1,000 rupees, so 1,000 units, right? It is 60 lakhs. So buying cost is, so making cost is this much and buying cost is this much, right? So what is our suggestion to the company? Company is a make to buy or buy or make a product or buy a product. So see that the making a cost is lesser than the buying a cost. So making cost is 47 lakh 50,000 and the buying cost is 60 lakhs. Why? Because fixed cost remain constant. Either you can produce a product or you make a buy a product, the fixed cost remain constant, right? So what is the decision here? Since the cost of making is lesser than the cost of buying, so it is advised to make a product, not the buy products. Okay. Why? Because the fixed cost is remain constant. You can buy a product or make a product. So this is one way that marginal costing very useful. Okay. So economic analysis using the COQ model or a purchase model or manufacturing model also we can take a decision. And break-even analysis, we know very well how we can break this. It is very useful for taking all kind of decision making. So see, we'll take an example. A manufacturer of TV buyers 10 TV cabinets at rupees 5,500 each. In case a company make its own in the factory, the fixed cost and variable cost would be 4 lakhs and rupees 300 per cabinets respectively. Should the company manufacturers make or buy the cabinet if the demand is 1,500 TVs? See that here. So if you buy at 500 rupees is better, or it can produce 300 is better. So demand is 15,000. So now they're asking either they can make a television cabinet or they can buy it. So which one is more profitable? Okay. Let us see this answer. So right. So selling price per unit 500. The variable cost is 300. The difference is 200 rupees, right? The fixed cost remain constant up to the break-even point is the no profit and no loss up to 2,000 units. But since the demand is only 1,500 units, so better to buy the product, not make the product. If the cost is less, but still the break-even point, right? The break-even point is 2,000 units. So if you can produce any product less than break-even point, the company may add in the losses, right? Company cost is high to compare this selling price. So like these break-even also very useful technique to take a decision by the buy product or make a product. Okay. So this is the way we can calculate this make or buy a product. So day to day, most of the companies they can use for this method, make a buy a product technique. Okay. So like variable surplus. The fifth one is, with this already we discussed, right? The alternative method of production. So the fifth application of marginal costing is fifth method of marginal costing application is alternative method of production. So it is interesting to note that the technique of marginal costing are very frequently applied for while comparing alternative methods of production. Whether one mission is to be employed instead of another, or mission or work or hand work. Right? What are the alternatives to produce a product? Instead of using manpower, introduce the technology is also one alternative. Right? Which one is most less costable? Right? It should be recommended that the basis of selection would be, however, the relative contribution available from various methods. The fixed cost remain constant. So whenever this talk about marginal costing, the basic assumption is fixed cost remain constant. That is, the method of production will be given, the greater contribution would be selected, right? So we'll consider this time factor, the limiting factor is also very important. It should be clear for taking a decision making process, right? So which method is used for production process? The sixth application of marginal costing is effect in changing selling price. So it is natural, all manufacturing companies, they are changing the selling price due to various factors. The competitive strategies, or they want to expand the product, right? So effect in changing selling price is another significant impact for creation of problems, particularly when the firm need expansion in business operations, or they want to sell the product in other markets, right? See, we'll take an example here. It's the income statement of X Limited for the year ending 31st March, 31st December. It given below for directors, company directors analyzing the data. So the income statement, the direct material, direct labor, direct overheads, and fixed cost of 1,10,000. The net profit is 47,500. The selling price is sales are 3,75,000 rupees. So the budgeted capacity of sales is 5 lakhs. Now the sales are 3,75,000. Now the company expected the demand for sales is 5 lakh rupees, and the sales demand is limiting factor. Now the sales manager of a company purposes, utilizing the existing capacity, they sell, the selling price will be reduced by 5%. Now they want to increase the sales, but through reduce the selling price. So if the company reduces selling price, the sales are increased. After this, considering the following additional information, they ask to prepare a forecast statement which will be affect this proposed reduction of the selling price. Means if the selling price reduce, the sales increase or not. So sales forecast 4,75,000. Okay, the price of the price of direct material are expected to be increased by 2%. The wages also increased by 5%, and the overhead is 5%. And the overhead expense increase also 5%. So here the changes, right? All are increased, and it is the calculation of statement showing the percentage increase of sales, and reduction of 5% discount is given, right? The total sales are 5 lakh rupees. The last year sales are 3,75,000, right? So before this forecast, in the actual data, sales are 3,75,000. Now the sales are increased to 5 lakhs, and the company is reducing the 5% its selling price. So what is the sales are increased? The sales are increased by 1,25,000. Once the selling price decreased, the sales increased at 1,25,000. What is the percentage of income increase? The percentage of increase is 33.33% of increase of sales. Sales in terms of percentage, right? Sales increased by 33%. What it means? If the reducing 5% of selling price reduced by 5%, and it influenced by increase of sales 33.33%. 33.33%. If we reduce the 5% of selling price, the sales are increased by 33.33%. Okay. Now, after this, see this in terms of rupees, all are increased 1,12,500, and additional cost increase. The sales price increases by 5% increase in prices 5,000. Okay. So like we'll take a decision, right? The direct material increase this much, and the fixed cost remain constant. The final one is, the final application is very much useful for shut down a firm or continue the firm. See that sometimes the companies are facing a problem to shut down the firm is better alternative, or continue the firm is better alternative. Due to various reasons, due to trade decision or unprofitable operations, or it is often to become necessary to management to suspend or close down the temporarily or permanently or a part of activity we should not be, which will not give any profitability. So in such situations, the absorption costing technique will be adopted for taking the decisions, right? Shed a firm or continue a firm. So some costs are again fixed, right? If you continue the firm or you can shut down the firm, the fixed costs remain constant. So based on this, the company may take a decision. Like let us go for one example. A company has 3 branches and the summarized cost, summarized accounting particulars are given like. So like the company has 3 branches and the Mumbai branch, Kolkata branch and Chennai branch. And out of 2 branches, Kolkata branch sales are 4,50,000. So Mumbai sales are 4,50,000 and Kolkata is 4 lakhs and Chennai is 7 lakhs. I mean, what it means, the Chennai sales are very high compared to Mumbai and Kolkata. The sales, the salaries of 40,000, 41,000, 60,000, advertisement, all and the expenditures are given below, right? So based on that, we'll take it decisions. Okay. So like these 7 are very applications of marginal costing. Applications of marginal costing, right? And any doubts? So like now in block 5, we're expecting problems as well as theory. Theoretical problems as theory is there. What is marginal costing? Explain the characteristics of marginal costing, right? And the problems for either make or buy a product or what we call sales mix, or it is called fixing a selling price. So like based on the applications, we'll expect the one problem in block number, right? Block number 4, right? Block number 4, we can expect one theory question, explain characteristics and importance of marginal costing, or else what we can call a distinction between marginal costing and absorption costing. It's one. And also, what are the applications of marginal costing also we can expect, and the problematic we can expect to make a byproduct, fixing a selling price, effective changing the selling price, shutdown and operating like key factors, like we can expect one theory and one problems. Okay. Now I will end my session. So tomorrow we are going to discuss last block. It is block number 5 and budgetary control and variance analysis. Okay. So tomorrow we're going to discuss what are the budgets and different types of budgets, budgetary control, standard costing and variance analysis. Okay. Now I close my session.